Watching a financial crisis unfold is like watching a cat try to jump onto a freshly waxed counter. You see the confidence, you see the wiggle, and then you see the absolute look of betrayal in his eyes as he mid-air realizes physics doesn't care about his feelings. Welcome to Trading Big Egg. This channel is all about decoding the economy from the ground up. No noise, just say. One day you're investing genius because you bought an MTF of a penguin. Next day you're wondering if your local bank is actually just 3 kids in a trench coat. Why does this keep happening? Most people think crises are black swan, unpredictable freak accidents. They're wrong. Crises are an accident. They're math catching up to reality. Today we're peeling back the curtain on the 4 horses of the financial apocalypse: excess debt, bad capital allocation, liquidity trap, and the systematic fragility. But before we dive into the wreckage, I have a question for the smart money in the room. Do you think the next crisis is already back into the system, or we're just one bad Fed meeting away from a cliff? Drug your bake or Fed in the comments right now. If you want to survive the next decade of volatility, you need to understand the plumbing. So hit that subscribe button and smash that like button, and share this video with one friend who still thinks this time is different. The debt supercycle. Debt is like a fire. Used correctly, it cooks your food. Used poorly, it burns your house down. In our modern economy, we don't use fire. We're basically living inside a giant bonfire. Debt essentially putting future consumption into the present. You get to buy the house, the car, or the company now, using money you don't even earn yet. This worked great until the futures arrive. When debt grows faster than the economy, the system becomes a margin call waiting to happen. Why? Because debt is a fixing obligation. The bank doesn't care if you lose your job or if your business had a bad quarter. They want their pound of flesh. The TradingBits X true. In a boom, everyone's confusing easy credit with real wealth, but when the credit turns into debt and the interest rate rise, the wealth evaporates. It was never there. It was just a hallucination fueled by a loan. Bad credit allocation. When money is cheap, people do stupid things. This is bad capital allocation. In a wealthy world, money flows to productivity things. New tech, better medicine, fishing energy. But in a bubble, money flows to zombies. These are companies that can't even pay their interest expenses with their own profits. They only stay alive by borrowing more money. We're talking about business model that only makes sense if the sun stays out forever. This creates a financial illusion. We build houses where no one lives and fund apps that lose $10 per customer. Eventually, the reality check hits. The market realize that billions of dollars have been incinerated in projects that don't produce anything. When the funding stops, the zombies die, and when they die, they take their banks and your portfolio with them. Exit door problem. Liquidity. Liquidity is the most dangerous word in finance because you only care about when it's gone. Think of a crowded theater. Liquidity is the side of the exit door. As long as everyone is sitting quietly watching the movie, everything is fine. But the second someone smells smoke, everyone's run to the front door at the same time. In a crisis, the door shrinks. Suddenly, you can't sell that rare crypto. Your house takes 6 months to move, and your stock are crashing 10% an hour. Price is what you hope it's worth. Liquidity is what you can actually get from it today. During a panic, value doesn't matter. Only cash matters. This is why good assets get sold alongside bad assets. People don't sell what they want to sell. They sell what they can sell. Have you ever tried to sell an asset during a crash and realized there were no bids? Tell us your horror stories below. Systematic fragility. Finally, we have systematic fragility. Our global finance system isn't a collection of separated islands. It's a giant game of Jenga. Everything is interconnected through derivatives and counterpart parties risk. Banks A owns Bank B, who owns a hedge fund, who is betting on the yen, who is tied to US Treasury. When a small piece of the bottom, say a subprime mortgage in Ohio or a small bank in Switzerland, get pulled out, the whole tower wobbles. The system has become so efficient that it has no redundancy. There's no buffer. We trade safely for minimum yields. We're now in a war where a glitch in one corner of the market can trigger a global meltdown for 8 hours. Stability creates complacency. Complacency creates risk. Risk creates the crash. It's a cycle, and we're currently on the edge of the ring. So why do crises happen? We borrow too much debt. We spend it on trash. We assume we can always leave, and we pretend the tower isn't leaning. The crisis isn't the star of the problem. The crisis is just the cleansing fire that burns away the lies we've been told ourselves during the boom. Recap for the legend still watch. Debt is the fuel. Bad allocation is the match. Liquidity is the missing fire extinguisher. Fragility is the wooden house. But knowing why things break is half of the battle. You need to know how to position yourself before the smoke starts. In our next video, we're taking this into a step further. We're going to look at inflation, growth, and asset price. We'll break down exactly how these crises affect your stocks, bonds, real estate, and your cash. Because in a world of chaos, the only thing better than surviving a crisis is profiting from one. Don't forget to like, share, and subscribe. Seriously, it helps the algorithm find people who actually wants to learn. And remember, money, markets, we're trading the future. See you in the next one.